Welcome to ZICA Academy tutorial on IAS 7, Statement of Cash Flows using Indirect Method. Ensure you watch the video to the end for better understanding. What is Statement of Cash Flows? A statement of cash flows provides information about where a business obtained its cash during the financial period and how it made use of its cash. It provides information about where a business obtained its cash during the financial period and how it made use of its cash. Cash flows are inflows and outflows of cash and cash equivalents. And inflows and outflows of cash and cash equivalents are said to be cash flows. And inflows and outflows of cash and cash equivalents. So cash, when we say cash comprises cash on hand and demand deposits. It comprises cash on hands. 2, demand deposits. So that is cash. So on the other hand, when we say cash equivalents are short-term, highly liquid investments. Short-term, highly liquid investments that are readily convertible to no amounts of cash and which are subject to an insignificant risk of changes in value. I repeat, cash equivalents are short-term, highly liquid investments that are readily convertible to no amounts of cash and which are subject to an insignificant risk of changes in value. So examples of cash equivalents include a bank deposit where some notice of withdrawal is required. Bank deposit where notice of withdrawals or some notice of withdrawals is required. So that is examples of cash equivalents. We can also have 2, short-term investment with maturity of 3 months or less. Short-term investment with maturity of 3 months or less. Example include the government bills. So these are examples of cash equivalents. So methods of preparing statement of cash flows. Methods of preparing statement of cash flows. In accordance with IAS 7, we have 2 methods of preparing statement of cash flows. Number 1 method is direct method, and the second method is indirect method. Indirect method. In this video, I will be focusing on indirect method of preparing statement of cash flows. Under both methods, statement of cash flows is prepared under 3 separate headings. Number 1 heading is operating activity. Operating activities. The second heading is investing activities. And the third heading is financing activities. These are the 3 headings under which statement of cash flows are prepared under both methods. So operating activities, I'm starting with operating activities. Operating activities are the normal trading activities of the entity. The normal trading activities of the entity. We refer to that as operating activities. Operating activities are those activities that arises in the normal course of business. That means they fall within the normal tentacles. They fall within the normal tentacles of the business. So, under indirect method, what we normally do is to reconcile the operating profit with cash flows from operating activities. So, in operating activities, what we want to do is reconciliation. Reconciliation of operating profit, or profit before tax, or profit before tax, operating profit or profit before tax, to the cash flows from operating activities. So I've told you, under this method, your operating activities, what you need to do is reconciliation. That means you want to prepare a reconciliation statement. So when you are preparing your reconciliation statement, there are three major items to adjust. So your reconciliation statement, let me give you the format for preparing statement of cash flows vis-a-vis my explanation. Format. So XYZ Limited. So you may have statement of cash flows for the year ended. The year end. If it is December 31st, 20XX. So I've told you the first heading is operating activities. Operating activities. That is the number one heading. And I've told you under this heading, what we normally do is reconciliation. You want to reconcile your operating profit with the cash flows from the operating activities. And I've told you there are three major items that are required for reconciliation. Number one are non-cash items. Non-cash items. So remember, I've told you want to reconcile what? Your operating profit or profit before tax. So we may just start with profit before tax. Then you now have adjustment for. I've told you there are three things that are required. There are three things that requires adjustment under this method. The first one is non-cash items. Adjustment for, let me have non-cash items. Examples of non-cash items include depreciation. So if you have any depreciation, you will need to adjust that. Depreciation will be added. Why? Because depreciation has been charged as an expense under the accrual principles. It has been charged as an expense. And when an expense increases, the profit reduces. So the profit before tax has been reduced by the depreciation. So you want to convert it to cash. So you add that depreciation back so as to neutralize the impact or to remove the effect of that depreciation from the profit. Since depreciation has been subtracted, just like minus, if depreciation is 2, that have been subtracted, and if you add that 2 back, minus 2 plus 2 is 0. That means depreciation has been totally removed by adding it back. Then the non-cash item may also include amortization charge. Amortization is just like depreciation. Then if you have impairment loss, any. Then if there are loss from disposal of an asset, loss from disposal of non-current asset, NCME non-current asset. Please take note of that. NCME non-current asset. Loss, if you have any of these, the consequences of these items is reduction of the net profit before tax. That means the profit before tax has been reduced by these items. You want to remove their effect or their impact from the profit before tax. That is why this item have to be added. Take note of that. If there are this profit on disposal, profit from disposal of non-current asset, profit on its own have increased the profit before tax, it has been added before. So you will need to subtract it in order to remove its effect from the profit before tax. So profit from disposal of non-current assets will be subtracted if it is a profit. These are some of the examples of non-cash items. Grant income, where there are income made. So maybe there are government grants. The income that have been recognized on that government grant will have led to an increase in the profit before tax. So we subtract since it has been added earlier. So after this adjustment, you may have plus or minus. It could be plus, it could be minus. Then after non-cash item, then number two items that requires adjustment are items that to be treated net of operating activities. Items treated net of operating activity. So items treated net of operating activities. So what this means is these items might relate to investing or they may relate to financing, but their effect or their impact have been included in the profit before tax. Take for instance, investment income. Investment income will be used to calculate the dividend received. So, and this dividend will have formed part of the investing activities. Since it has been included in the profit or loss and it has been added in getting the profit before tax, that means you will need to remove that investment income. Interest income or interest received. Interest received will be included in investing activities. Where it has been included in the profit or loss, then you will subtract that. Then interest received. Then we may also have items such as share of associate profits, a profit or loss. So, and this will be used to calculate dividend receipt from associates, which will be reported as investing activities. So where it has been included in the profit or loss, you remove that. Then your finance costs, which will be used to calculate the interest paid. Finance costs on its own have been subtracted earlier. Since the finance costs have been subtracted, then this time you will add it to neutralize the effect or the impact of that finance cost from the profit. So we add the finance cost, if any, it will be added. Then after all this adjustment, you arrive at, it could be plus, it could be minus, so depending on the question. So the third items that requires adjustment are changes in working capital. Changes in working capital, that is the third items. I've told you, you want to do reconciliation under this method, under indirect method. What you want to do is reconciliation. I've told you your operating activity, you want to reconcile your operating profit to cash flows from operating activities. In your reconciliation, I've told you, you start with the profit before tax, then you adjust for the items listed. The first item are non-cash items, and the second one are item treated net of operating activity. This is activity, please take note of that. And the third item are changes in working capital. And when we say working capital, we are referring to items of current assets or current liabilities. Working capital will mean current assets and current liabilities. So, and for the purpose of statement of cash flows, you may be given two statements of financial position. The essence of that is for comparison. You want to ascertain whether there is an increase or a decrease in any of the items you need, or you want to ascertain the opening and the closing balances. That is why two statements of financial position will be provided for exam purpose, but one statement of profit or loss is required. Where even though you are given two statements of profit or loss, it is only that of the current year that will be required. You don't need the comparative statement of profit or loss. You don't need the statement of profit or loss for the comparative period. You don't need the previous year statement of profit or loss. It is the current year statement of profit or loss you need. Please take note of that. I've told you changes in working capital, there are items of current assets and current liabilities. But anything that is cash or cash equivalent, you must exclude them. So your current asset, if you have increase, I'm starting with current assets. You may have increase, you may have decrease. In, let's say, inventory. Inventory is part of your current asset. Increase. Now, where your asset increases, profit will increase. Increase in asset means increase in profit. To neutralize the impact of that, you subtract. Increase in asset, you minus. Why decrease in asset should be added. Take note of that. It could be plus, it could be minus. The increase or decrease in trade receivables. Increase or decrease in trade receivables. Increase is minus, while decrease is a plus. Increase or decrease in trade receivables. Increase minus, and still on current assets. Will decrease in prepayment. Increase minus, decrease plus, because these are assets. After this asset, you don't consider cash. I've told you anything that is cash or cash equivalent should be excluded. Then we have current liabilities now. Liability is opposite the asset. Increase in liability should be added, but the decrease should be subtracted. It is opposite of the asset. You know, increase in asset was to be subtracted, but that of liability, it is the increase that will be added. So increase, you subtract the decrease in liability. In trade payables, you add the increase, you subtract the decrease. Increase stroke decrease. Those things I put in bracket, that means you are subtracting those ones. Why those ones I didn't put bracket, that is add. Increase or decrease in accruals. Increase or decrease in accruals. Then after all these adjustments, you have the net cash flows. Then you have this. It could be plus, it could be minus. Now, remember, you have three things to add. The number one is the profit. Four things to add or subtract. The number one item is profit before tax. The second one is non-cash items, which could be plus or minus. While items net of operating activities, which could be plus or minus. And the changes in working capital, which could be plus or minus. After all these adjustments, you arrive at the net cash flows from operating activities before tax. So this adjustment, you have this. Then you now have interest paid, if any. If you have interest paid, this interest paid may occasionally be the same as your finance cost. I've told you that interest paid will occasionally be the same as finance cost where there are no interest payable. So it means before you can include your interest paid under operating activities, before you subtract it there, then you have to check your current liabilities in case you have interest payable there. Or sometimes you will be told in additional information. It may not be given in the face of the statement of financial position under current liability, but you'll be told by the way of note. That means you need to check your current liabilities or your note to ascertain that there are interest payable in the period. Working number 1, you have interest paid. You want to calculate the interest paid. In all my workings, I will always start with the opening balance. I've told you for the purpose of statement of cash flows, there are 2 statements of financial position will always be provided. Number 1 is the opening and the other one is closing. In case you have 2025 and 2024, the 2024 is the opening, while 2025 is the closing. Anytime you are in need of the closing balance, you check that of the current year. If you need the opening balance, you check the most previous or the previous year. So you start with the opening balance. Opening balance. Where will the opening balance be found? To be found under it will be found in the opening entry. That is the opening statement of financial position. Now, interest payable. Since it is interest payable, you need the interest payable. I've told you it may be given under the current liability or in additional information. Then after the interest payable, you add your finance cost. Finance cost. The finance cost is the interest expense or interest expense. The amount of interest that is charged as an expense in the period, you add it. Then after this, you subtract the closing balance. The closing balance, that is in respect of your interest payable. Interest payable. I've told you that the closing balance will be found in the closing statement of financial position under the current liabilities. So after this, you get the amount paid, interest paid. It is this interest paid that will be shown under your operating activities that will be subtracted here. So you have interest paid, that amount will be subtracted there. Then after this, you have taxes paid. Taxes paid. I am still under the operating activities. Then the working number 2, the second working will be the amount of tax paid in the period. The tax paid in the period is what you will have in the working number 2. So working 2 now, taxes paid, taxes paid. All your opening and closing balances will be found in the statement of financial position. Please bear that in mind. So as usual, I've told you in all our adjustments, you have the opening balance. So your opening balance, I've told you, it will be found in the statement of financial position. But in respect of tax, there are 2 places or 3 places tax information may be found in the statement of financial position. You may have it under non-current asset, which is deferred tax asset, but it's not very common. Then you may also have deferred tax liability under non-current liabilities. So the opening balance, you pick that deferred tax liability. Then in your current liability, you have your current tax there, current tax. Then you now have tax expense. Tax expense, the amount of tax that is expense in the statement of profit or loss, you add that. Then if you have tax offset, that is under other comprehensive income. Tax offset, so you add. So after this adjustment, you subtract the closing balances. You subtract the closing balances. So your closing balance, I remember I've told you all the opening and the closing balances will be found in the statement of financial position. The opening balances will be found in the opening statement of financial position, while the closing balances will be found in the closing statement of financial position. The closing balances include deferred tax liability, deferred tax liability, which will be found under the non-current liabilities. Then you have current tax. This one will be found under current liability. After summing them up, you subtract it from this total, you get the tax paid. Tax paid. Now, this is how you get the amount of tax paid, the amount paid as tax that will be recognized in the statement of cash flows under the operating activities. After you've subtracted the tax, you get the net cash flows from operating activities. So you get the net cash flows from operating activities. After the operating activity, the next section is investing activities. Investing activities. Investing activities are activities that involve acquisition and disposal of long-term assets and other investments that are not included in cash and cash equivalents. Acquisition and disposal of long-term assets and other investments that are not included in cash and cash equivalents. So whenever you get to this section that is under the investing activities, what you should always examine is changes in non-current assets. So this is what you should always check. Movement in the non-current assets. You check the movement in non-current assets. Remember, your non-current assets include property, plant, and equipment, intangible assets, and financial assets, and others. So now, investing activities. I've told you you should always check the movement in non-current assets. Let me have working number 3. So we may have movement in property, plant, and equipment. So remember, I've told you in all my workings that I always start with the opening balance. I've told you that all the opening and the closing balances will be found in the opening and the closing statement of financial position respectively. So opening balance in respect of PPE. There are a number of adjustments that needs to be effected, that needs to be incorporated into the movement in non-current assets. Number one, non-current asset may be depreciated, so you may have depreciation. So if there are depreciation, the PPE will reduce, so you subtract the depreciation. Aside depreciation, the PPE may be revalued. So if it is revalued upwards, you may have revaluation surplus. Revaluation surplus, that is where it has been revalued upward. That means the PPE will increase, so you add it. If it is revalued downwards, you have revaluation deficit. So you subtract. That means PPE will reduce where it is revalued downwards. Aside the depreciation and revaluation, PPE may be disposed. And where there are disposal, you may have disposal of PPE here, disposal. So you remove it, PPE will reduce. And if there are acquisition of PPE during the period, so let me say the carrying amount is what I prefer to have here, carrying amount. Why carrying amount? Remember, this opening balance is equivalent of carrying amount obtained from the statement of financial position. This figure was lifted from the statement of financial position as the carrying amount. Then the disposal too, you have to, so that everything must be incongruent, so that everything will be at their carrying amount. So now, after this adjustment, you subtract the closing balance. So if there are acquisition of PPE during the period, this closing balance will be negative. This value will be negative. The closing balance will be greater than this. So you have negative. That is acquisition. So an acquisition of PPE will result in an outflows of cash or cash equivalent. So this acquisition of PPE will be reported as investing activities. So you have acquisition of PPE during the period, acquisition of PPE. That is working number 3. So acquisition results in an outflows of cash. The proceeds from disposal of PPE. Let me have this as working number 4. In some cases, this proceeds will be given, but where it is not given and there are information, so there are information provided in the questions which have shown that there are disposal of PPE. Maybe you have the loss from disposal obtained from the statement of profit or loss or from the note, or you have profit from disposal given or obtained from the statement of profit or loss or from the note, or you have the there are information. So where you have such information, that means PPE have been disposed. In that case, if you check the movement in PPE, if the acquisition may be given in the question, if it is added, then the total here will be greater than the closing balance. The difference will represent the carrying amount of the PPE disposed. If you add the acquisition of PPE here, you add the acquisition of PPE, you get this as the total. Now subtract the closing balance. This total will now be, it will be greater than this. So where it is greater than this, that means the difference here will represent disposal of PPE, disposal which is carrying amount of PPE disposed. That is what you will get from this movement in PPE. Then from the carrying amount, now you now use it to calculate the proceeds from disposal. Working number 4. Proceeds, we now have proceeds from disposal of PPE. Proceeds from disposal of PPE. Then you want to calculate the proceeds. The starting point is the carrying amount obtained here. So you have carrying amount. Remember, carrying amount is cost less accumulated depreciation. Carrying amount of PPE disposed. Carrying amount of PPE disposed. Then if the PPE is sold at a profit from disposal will be added. Profit from disposal of PPE. That profit will be added. If I've told you, the profit may be given in the face of the statement of profit or loss or by the way of note. Then you have loss from disposal of PPE. You subtract the loss. After this, you get the proceed. It is this proceed that will be recorded as an inflows under the investing activities. I've told you, in most cases, the proceed from disposal will always be given in the question. It will be given in most cases. But where it is not given, that is how you can see profit or loss from disposal or PPE in the question. Then you know there are disposal. After you have done your movement in PPE, to get the carry amount of the PPE disposed, then you now calculate the proceeds from disposal using this format. Remember, these profits or loss, they are mutually exclusive. You either have profit from disposal or you have loss from disposal. You cannot have both in the same question. Only one of the two items will be provided. Please bear that in mind. Now, government grant received during the year grant received. Received is an inflows. Then you have investment income received. Investment income received or dividend received is the same. Dividend is an investment income. Dividend received. Whether you put dividend received or investment income received, I see these two to be the same. So the interest received. Interest received. This interest received may be given in the question, but in some cases you may be expected to calculate it because you may be given the interest income in the statement of profit or loss. Remember, your statement of profit or loss has been prepared in line with the accrual basis of accounts, but your statement of cash flow follows cash basis. Now, the interest income recognized in the statement of profit or loss may not be the amount of interest received in the period. Therefore, you will need to calculate the amount received as an interest in the trading period. So to calculate the interest received now, so you check your current asset. In case you have interest receivable, and if it is not given in the current asset, it may be given by the way of the note, working number 5. Then we have interest received. You want to calculate the interest received. I've told you under your current asset, you may have interest opening balance as usual, opening balance. That is interest receivable. Interest receivable. That is under current asset. Then interest income. Interest income. The interest income will be obtained from the statement of profit or loss. Interest income will be obtained from the statement of profit or loss. If you now add this, you have this at the total. Then you have the closing balance. Closing balance. That is your interest receivable under current assets. So if you subtract this, you get the interest received. It is this interest received that will be recognized as investing activities. Working number 5. This will appear as investing activities. Then acquisition of intangible assets. Acquisition of intangible assets. Intangible assets, you know it is part of current assets. Intangible assets, if there are acquisition, the closing balance will be greater. You subtract outflows. Acquisition of investment, the long-term investment. Acquisition of investment. Those investments that are not found under the non-current asset. Even this your PP, if there is an acquisition, if you have acquisition through lease, let me say right of use asset, it will be added. Right of use asset. If you have asset acquired through lease asset, you add it here. Don't forget. So it may be given in the question. You add it. After all these adjustments, you have the net cash flows from investing activity. Net cash flows from investing activities. So it could be an inflows or outflows. It could be plus or minus. After investing activities, the third heading is financing activities. Financing activities. Financing activities are those activities that result in changes in non-current assets and borrowings. Financing activities. Every businesses have two major sources of finance. So, capital structure of the business comprises equity and borrowings. Equity and debt. Equity and debt. So, these are the major sources of finance every businesses have. So, equity. I've told you those activities that result in changes in equity and borrowings, we refer to those activities as financing activities. So it means whenever you get to this section of statement of cash flows, you are expected to check the movement in equity and the movement in borrowings. So now working number 6. Working 6, movement in equity share. Movement in equity share. So as usual, you start with opening balance. Opening balances. Your opening balances might have ordinary share. You may also have share premium. No, you may have a bonus issue. A bonus issue is an issue of shares to an existing shareholders, and no cash is involved. Bonus issue can also be called capitalization issue or scrip issue, when the entity capitalized part of their reserve as an additional shares. So in case of bonus issue, no cash is involved. But bonus issue should be made out of share premium. Where bonus issue are made from share premium, information about the bonus issue should be ignored, because share premium, the movement is already between this and this. Where bonus issue are made from share premium, ignore the bonus issue totally. But bonus issue from retained earnings, bonus issued made from retained earnings, that one will require adjustments here. So you add it here. So if it is made from retained earnings will have been debited, and the share capital will have been credited. So then after this, you have this at the total. Then you have the closing balances. So which comprises your ordinary share capital, and your share premium. Then after this adjustment, you have this. What you have here is the issue of shares. If there are issue of shares, the closing balance here will be greater. So that means this will be negative. The closing balance will be greater where there are issue of shares during the period. So your issue of shares, that will appear under the financing activities. Working number 6, you have your issue of shares. Then you may have dividend paid. Where dividend is paid during the period, it may be given in the question, but where it is not given, you check the movement in retained earnings. Working number 7. Movement in retained earnings. Where dividend paid is not given, you check the movement in your retained earnings. As usual, we are starting with the opening balance. Opening balance in respect of retained earnings. Your retained earnings. You take the opening balance in retained earnings. I've told you that all the opening balances will be found in the opening statement of financial position. Then after the opening balance, we now have profit for the year. Profit for the year. The profit for the year will be obtained from the statement of profit or loss. Then you add. Then you subtract the closing balance. The closing balance. If this is greater than the closing balance, that means certain amount has been paid as dividend. So you have dividend paid. So dividend paid is an outflow of cash. So you subtract that. If there are issue of loans, notes. The loan note, the closing balance will be greater than the opening balance where there are issue of loan notes. That results in an inflows of cash. Repayments of loan notes, repayment of loan notes. Where loan notes are repaid, the closing balance will be lower than the opening balance. You may have lease payment. Let me have this as working number 8. So, working 8, lease payment. So, you, as usual, we start with the opening balances. Opening balances. In respect of the lease, you may have one under non-current liability. Non-current liability, the opening balance could be there in the opening statement of financial position. You may also have another one under current liability. Current liability, it may appear as lease obligation. Then lease asset or right of use asset. You add this. You have this as the total. After that, you consider the closing balances. The closing balances, closing balances. Just like the opening balances, you may have non-current liability, non-current liability, that is the lease obligation, which is given under non-current liability, and the one given under current liability. So after this, you get the amount paid, the lease payment. So this amount paid, you will include that under current, under financing activities. So we have this as financing activities. So lease payment. After all these adjustments, the sum of this is net cash flows. Net cash flows from financing activities. This could be plus and it could be minus. What you have under operating activity plus that of the investing activities plus that of the financing activity, that will give you the net cash change. Net cash change. If you don't want to call this net cash change, you can call it increase in cash or cash equivalent, or if it is negative, you have it as decrease in cash or cash equivalent in the period. Then you now add opening balance in respect of your cash or cash equivalent. So the opening balance could be plus or it could be minus. So you now have the closing balance. Closing balance. So the closing balance, so could be plus or minus as well. So the opening balances and the closing balances may comprise the cash in hand, cash at bank, short-term investment, and the bank overdraft. ICAN May 2025 financial reporting question number 1. The financial statements of Shukuka Nigeria Limited are drafted below. Statement of profit or loss for the year ended April 30, 2025. Amount is in million naira. Revenue 164 billion 985 million naira. Cost of sales 118 billion and 95 million. Gross profit of 46 billion 890 million. Interest received 1 billion 670 million. Then administrative expenses 25 billion and 25 million. Finance cost 5 billion 220 million. Profit before taxation 18 billion 315 million naira. Income tax expense, we have income tax 6 billion 642 million. Deferred tax 2 billion 208 million. The total is 8 billion 850 million naira. Profit for the year 9 billion 465 million. Statement of financial position as at April 30. We have 2025 and 2024. Amount is in million naira. We have assets which include non-current assets And the non-current assets include property, plant, and equipment, 29 billion 235 million for 2025, 23 billion 475 million for 2024. Intangible assets of 18 billion 775 million and 16 billion 300 million for 2025 and 2024 respectively. Trade investment 1 billion 835 million and 2 billion 860 million. Current assets, it includes inventories 11 billion 550 million for 2025, 7 billion 875 million for 2024. Trade and other receivables 31 billion 440 million in 2025 and 25 billion 335 million in 2024. Then short-term investment 3 billion 810 million and 2 billion 790 million. Cash in hand 930 million and 360 million. The total of assets, 97 billion 575 million and 78 billion 995 million in 2025 and 2024 respectively. Equity and liabilities. Equity include ordinary share capital of 1 naira each, 15 billion and 11 billion 250 million. Share premium account 10.5 billion and 9.3 billion. Revaluation reserves 11 billion 280 million and 9 billion 195 million. Retained earnings 17 billion 925 million and 13 billion 860 million naira. We have non-current liabilities 10% loan notes 12 billion 780 million and 6.5 billion. Deferred tax 1.5 billion and 3 billion 750 million. We have current liabilities, which include trade and other payables of 12 billion 810 million and 9 billion 150 million. Bank overdraft 6 billion 540 million and 7 billion 530 million. Current tax payables of 9 billion 240 million and 8 billion 460 million. The total of equity and liabilities is 97 billion 575 million for 2025 and 78 billion 995 million for 2024. We have additional information. 1. A financial asset included in the trade investment with a carrying amount of 1.5 billion naira was sold for 1 billion 885 million naira during the year, while a replacement was also acquired. Note 2. There was an issue of 3 billion 750 million, 3 billion 750 million ordinary shares during the year at a premium of 32 kobo per share. Note 3. The short-term investment is highly marketable with 1 to 3 months maturity profile. Note 4. During the financial year, the company paid dividend of 5.4 billion to equity holders, and this had been accounted for during the year. Note 5. One delivery van with an original cost of 6.6 billion naira and a carrying amount of 3 billion 750 million naira was sold for 2 billion 520 million naira during the year. Note 6. The company is planning to take a long-term syndicated loan of 2 billion naira from a healthy Nigerian bank. The company's financial statement and loan application has already been submitted to the bank and is awaiting approval. Note 7. Extra from property, plant, and equipment schedule reviewed. We have 2025 and 2024. Amount is in million naira. Cost 55 billion 395 million naira and 45 billion 795 million naira for 2025 and 2024 respectively. Accumulated depreciation 26 billion 160 million naira and 22 billion 320 million naira. The total is 29 billion 235 million naira and 23 billion 475 million naira. Note 8. A cash payment of 58 million naira made in respect of insurance premium for the financial year ended April 30, 2025 was totally omitted in the books. Required. A. Prepare a statement of cash flows for Shukuka Nigeria Limited for the year ended April 30, 2025 using the indirect method. B. In the context of IAS 7, statement of cash flows, explain the term cash and cash equivalent and give 2 examples. C, solution. In the first requirement, that is requirement A, you have to prepare a statement of cash flows for Shukuka Nigeria Limited. So we have Shukuka Nigeria Limited. You want to prepare a statement of cash flows, statement of cash flows for the year ended, and the year end of this entity is April 30, 2025. For the year ended April 30, 2025. You have to use indirect method. You want to use indirect method. Amount is in million. Indirect method. The first heading is the operating activity. Operating activities. I've told you that in this section of statement of cash flows, you want to reconcile the operating profit to the cash flows from the operating activity. So you are starting with the operating profit, or you can start with the profit before tax, profit before taxation, which is 18,315,000,000. So we have profit before taxation of 18,315,000,000. 18,315,000,000. So after the profit before taxation, then you have the adjustments. Adjustment for. I have told you that there are 3 items that require adjustment under this section. The first thing are non-cash items, and the second items are items that does not involve the flows of cash, and the third one is working capital or changes in working capital. So now let's run our eyes through the face of the statement of financial position to see if there are any of the 3 items I've mentioned that will require adjustment. The first item, we have interest received. Remember, the interest received is investing. That is to show that this is an item to be treated net of operating activities. So it will require adjustment. It have no interest received is an income. Income have increased the profit before tax, so it will be subtracted. So we have interest received. Interest received. And interest received amounted to 1670. I've told you it will be subtracted since it has increased the profit before taxation. So we want to subtract that. That is why I put it in braces. Aside the interest received, you can also see finance cost. It should be treated as a separate item. So a line item, so it will require adjustment. It's an item to be treated net of operating activities. 5220. 5220. 52 finance cost. That is interest expense. Finance cost 5220. You know, it was deducted in the course of preparing the statement of profit or loss. That means it has led to the reduction in the profit before tax. That is why the finance cost is to be added. After this, if you look at the items in the face of the statement of profit or loss that you can identify up to this section, so there are no items that require further adjustments that we need here. So I've told you, you don't need anything after profit before taxation, since our starting point is profit before taxation. So items that will require adjustments are those items that have a bearing, whose effect have been included in this profit before tax, are the only items that will require adjustment. Now, let's go through the footnote to see if there are further items that will require adjustments. Note 1. A financial asset included in the trade investment with a carrying amount of 1.5 billion was sold for 1,885,000,000 during the year, while a replacement was also acquired. So this is a disposal of a financial asset, so which is an investment. So that is why it was reported as non-current asset in the statement of financial position. Remember, your trade investment have been reported as non-current asset, and that means the financial asset too have been reported as non-current asset. I told you that the movement in non-current asset will be adjusted under investing activities. So because of that, but this profit now is not a cash flows. The profit from disposal does not involve the flows of cash. And the profits from disposal have been included in the financial statement. The profit is different from cash. They are inversely conflating. The relationship between the profit and cash are inverse relationship. So now if you look at this, the proceed is different from profit. Proceed involve cash, but the profit is not cash. Therefore, the profit which have been included in the profit before tax will need to be deducted. So we now have profit from sale of financial asset. Financial asset. We were to included in trade investment. The carrying amount is 1.5 billion, and the proceed is 1,885 million. 1,885 minus 1.5 billion. So you have the profit of 385. The profit has increased it. So that is why we will subtract the profit, because profit has increased the profit before tax. So that is for now. Now let's go to note 2. There was an issue of 3,750 million ordinary shares during the year at a premium of 32 kobo per share. This is an issue of shares. It has nothing to do with the profit before tax. It does not have anything to do with the profit or loss. So it will only appear in the equity sections of the financial statement. Note 3. The short-term investment is highly marketable with 1 to 3 months maturity profile. So the 1 to 3 months implies that it is a short time, it is highly liquid. And we said a highly liquid investment, short time highly liquid investment, we said those items, we refer to them as cash equivalent. So that means this will form part of our cash equivalent. So as a result of that, it has nothing to do with the statement of profit or loss. It doesn't have anything to do with profit before tax. Note 4. During the financial year, the company paid dividends of 5.4 billion to equity holders, and this had been accounted for during the year. So the dividend paid is an equity item. So if you look at dividend paid, it was not used in the face of the statement of profit or loss. It is an item of equity. So that is why it will appear under the financing activities. Note 5. One delivery van with an original cost of 6.6 billion and a carrying amount of 3,750 million was sold for 2,520 million during the year. So the carrying amount of the delivery van sold is lower than the proceed. The proceed is 2,520 million. The difference between the carrying amount, the excess of carrying amount over the proceed is a loss from disposal of delivery van. So we will need to calculate the loss on disposal of delivery van. The loss will have led to reduction in the profit before tax. So because of that, we will add it back, since the profit before tax has been reduced by the amount of the loss from disposal. And that loss will be the difference between the carrying amount and the proceeds of 2,520 million naira. Loss from disposal of delivery van. We say it is a loss because the carrying amount is greater than the proceed. The carrying amount is 3,750 million. And the proceed is 2,520 million. So leading to a loss of 3,750 minus 2,520. So we have 1,230 million. We said the loss has reduced the profit before tax. Loss was treated as an expense, so that means the profit before tax has been reduced. That is why we are adding the loss back. Back to the note 6. Note 6. The company is planning to take a long-term syndicated loan of 2 billion naira from a healthy Nigeria bank. The company's financial statements and loan application has already been submitted to the bank and is awaiting approval. So this is a plan. The company is planning to take it. That means that loan has not been taken. It has not, even though the application has been submitted to the bank and that application is still awaiting the approval. It is not yet sure, the entity is not yet sure that this loan will be released to them by the bank. So as a result of that, and this does not meet the recognition criteria as a liability. Since it hasn't been recognized in the financial statement, that means we have nothing to do with this, since it has not been recorded at all, and this loan have not yet been released to the company by the bank. Note 7. Extract from property, plant, and equipment schedule reviewed. You have 2025 and 2024. You have the cost of the asset. You have the accumulated depreciation. If you look at the accumulated depreciation, for 2024, you have 22 billion 320 million naira. And for 2025, you have 26 billion 160 million naira. If you look at this accumulated depreciation, it have increased. The amount by which 2024 and 2025 exceed that of 2024 is an increase in depreciation. And that increase in depreciation represents the amount of depreciation charged in the year 2025. So the depreciation charge in the year would have been expensed in the statement of profit or loss. So we will need to find the difference between this and add it back, because depreciation is not a cash flow, it's a non-cash item. Depreciation charge in the year. Depreciation. How much is the depreciation charge in the year? So the difference between 2025 depreciation of 26 billion 160 million, that is the depreciation for 2025, and that of 2024 is 22 billion 320 million minus 22 billion 320 million. So the difference, 26 160 minus 22 320, and the difference is 3 billion 840 million. That is the depreciation charge in the year as an expense in the statement of profit or loss, and this depreciation will have led to reduction in the profit before tax. So that is why we are adding it. It's not a cash flows. Then after these adjustments, you may have 1670, which is negative, plus 5220 minus 385 plus 1230 plus 3840. Then you have 8235. That is the addition of this. If you add these two, 18315, then you have 26,550. Note 8, you have a cash payment of 58 million made in respect of insurance premium for the financial year ended April 30, 2025 was totally omitted in the books. Now this insurance premium paid, the entity ought to have charged this as an expense in the statement of profit or loss, thereby debiting the profit or loss and credit cash. So, and this was omitted from the books of the entity. So as a result of that, so this expense should be recognized. So when it is to be recognized now, we deduct it in the statement of profit or loss, then from operating activities. Note, insurance premium is an administrative expenses, so it will be treated as part of operating activity. Then the cash implication, since it was paid, the cash of the entity will reduce. So it should be credited to cash. That means when we get to cash and cash equivalent, the 58 million should be deducted. Insurance premium paid of 58 million naira. So it should be treated. Then After this, we now have for changes. You have adjustment for changes in working capital for the period. Changes in working capital. Remember, working capital are items of current assets and current liabilities. We are starting with the current asset as the components, as a component of working capital. The first thing, you have inventories. That of 2025, we have 11,550. 2024, 7,875. The 2025 is greater than 2024. So since the current year is greater than the previous year, that means you have an increase in inventory. So we have increase in inventories. 2024, we have 7,875 minus that of 2025. The 2025 is 11,550. 11,550. That of 2025 exceeds that of 2024. 7,875 minus 11,550. You have the difference of 3,675. 3,675 negative. 3,675. I've told you, increase in asset, we subtract. Increase in asset, we subtract. Because increase in asset means increase in profit. And increase in profit should be subtracted. Now, after increase in inventory, then you have trade and other receivables. The current one is greater than the previous one. That means you equally have an increase. Increase in trade and other receivables. The opening 2024 amount 335 minus the closing 31,440. How much is the increase? 335 minus 31,440. Then you have 6,105 increase minus. Then the next item, you have short-term investment. And then from note 3, you were told that the short-term investment is highly marketable. It's highly marketable with 1 to 3 months maturity profile. Since this is a short-term investment which is highly marketable, highly liquid, we said this is a cash equivalent. So cash equivalent should not be considered. And anything cash or cash equivalent should be excluded. Then the cash in hand is also a cash item. This should equally be excluded. Remember, liability is opposite of the asset. So look at the current liabilities, trade and other payables. The 2024 is 9,150, 2025 12,810. 2025 is greater. That means you have an increase in trade and other payables. Increase in trade and other payables. The 2024, we have 9,150 minus 2025, which is 12,810. 12,810. So how much is the increase? 9,150 minus 12,810. Then you have increase of 3,660. If liability is opposite the asset, increase in asset is minus, that means increase in liability will be plus. Now we have bank overdraft. Bank overdraft is, of course, a cash item, so it should be excluded. Current tax payables. The current tax payables will be adjusted in the calculation of the amount of tax paid for the period. Then after all this, since we have done with current assets and current liabilities, so what do you have as the total? So you have 3675, which is negative, minus 6105. Then you have minus 9780 plus 3660. Then you have minus 6120. Negative 6120. After these adjustments, so what do you have? So 6120. Remember, in your operating activity, what you had before was 26,550 plus 26,550 minus 58 minus this. So you have 20,372. 20,372 million. If you go through your statement of profit or loss, you have finance costs. And if you equally check your current liabilities, there is nothing like interest payable. And since there is no interest payable under current liabilities in the statement of financial position, that is to show that the entire finance cost has been paid in the period. So that means we have this as interest paid, 5220. So interest paid, that is your finance cost, which is 5220. After interest paid, you want to consider the taxes paid. Taxes paid. We will have this as working number 1. This will be the first working under this. So the taxes paid. Then if you go through the statement of profit or loss, you have the tax, income tax expense of 6642 and the deferred tax of 2208. So you have total of 8850. That is the taxes paid. Then let's go through the current and the non-current liabilities to see if there are anything that requires adjustment there. Working number 1. We have taxes paid. Taxes paid. That is the first working. Amount is in million naira. Remember, in all our workings, we normally start with the opening balances. Opening balances. So we have current tax payable. The opening balance is 8460. Current tax payables. And that amounted to 8460. Then we equally have the deferred tax, 3750. The opening balance, deferred tax. That is 3750. 3750. Then we have tax expense. Income tax expense. Income tax expense. From the statement of profit or loss, so statement of profit or loss, you have the tax expense of 8850. 8850. If you sum them up, you have 8460 plus 3750 plus 8850, and that is total 21060. Then after this, you have the closing balances. Closing balances. And your closing balances also include the current tax payables, current tax payables. And then we equally have deferred tax. Now, the current tax payables, the closing balance we have 9240, 9240, and the deferred tax we have 1.5, 1,500. After these adjustments, how much do you have as the tax paid? 21,060 minus 9240 minus 1,500. Then you have 10,320. 10,320. That is taxes paid. Taxes paid. That is the amount paid as tax during the period. And this tax paid will be reported on under the operating activities. So we deduct it there. So we have taxes paid from working one, which is 10,320. If you subtract that, so 2372 minus 5220 minus 10,320. So we have 4832. 4832. That is the net cash flows from operating activities. After the operating activities, the next heading will be the investing activities. Remember, I've told you that investing activities are activities that result in changes in non-current assets. Investing activities. I said these are activities that result in changes in non-current assets. Our non-current assets include property, plant, and equipment. So we want to check the movement in property, plant, and equipment. Working number 2, movement in property, plant, and equipment. As usual, we are starting with the opening balance. Opening balance of property, plant, and equipment. How much is this? Then we have the opening balance to be 23,475. 23,475. Now, let's go through the note. What are the items in the note that have effect in the PPE that we are looking at? Note 1 is a financial asset included in trade investment. So it doesn't have anything to do with property, plant, and equipment. So we leave that. Note 2, there was an issue of 3,700,000,000. This is issue of shares. It has nothing to do with property, plant, and equipment. Note 3, the short-term investment is highly marketable. So that is short-term investment, and that does not have anything to do with the property, plant, and equipment. Note 4, during the financial year, the company paid dividend. The dividend paid has nothing to do with the property, plant, and equipment. So now let's move to note 5 rather. One delivery van with an original cost of 6.6 billion and a carrying amount of 3,750,000,000 was sold for 2,520,000,000 during the year. So there is a disposal of delivery van during the year, and delivery van is part of the property, plant, and equipment. So that will have effect on that. So we have disposal of delivery van. Disposal of delivery van. It is the carrying amount that will be used. Carrying amount of the delivery van disposed. So the reason for that is because this value we are using here is carrying amount. So what we need for further adjustment must all be at their carrying amount. We were to one delivery van, that same note 5, with an original cost of 6.6 billion and a carrying amount of 3,750,000,000. So 3,750,000,000, that is the carrying amount. We remove it from delivery van. Why the proceeds of that delivery van should be reported as investing activities. And how much is the proceed? You were told one delivery van with an original cost of 6.6 billion and a carrying amount of 3,750,000,000 was sold for 2,520,000,000. The proceed should be reported as investing activity. Proceeds from sale of delivery van. Proceeds from sale of delivery van. And that proceed from note 5. Note 5. The proceed was given to be 2,520,000,000. Proceed is the amount received from sales of the delivery van. So the amount received is an inflows. When you sell an asset, you receive cash. That cash received is an inflows. Therefore, it should be reported as investing activities, as an inflows. Now, back to the note 6. The company is planning to take a long-term syndicated loan. I've told you that has nothing to do because they are only planning, so it have not been received. So we don't need that. Then note 7, an extract from property, plant, and equipment schedule reviewed. Depreciation charge during the year. The difference is the depreciation charge in the year. 26,160 minus 22,320. So that depreciation charge for the year. Remember, depreciation charge, we affect the asset, we affect the delivery, we affect the PPE. Where depreciation is charged, so the PPE will reduce. So because of that, we have depreciation charge in the year. So which is the difference between 26,160 million minus 22,320, 22,320 million. So how much is the depreciation charge in the year? 26,160 minus 22,320. There you have 3,840. 3,840. Depreciation leads to reduction in the property, plant, and equipment. After note 7, we have note 8. Note 8, you were told a cash payment of 58 million made in respect of insurance premium. So that is insurance premium paid. So it doesn't have anything to do with the property, plant, and equipment. So because of that, so we may not need that here. Though, remember, the insurance premium paid has been considered as part of the operating activities. So under equity section of the statement of financial position, you have revaluation reserve. 11,280 as the closing balance and 9,195 as the opening balance. So that means there is an increase in revaluation. That increase in revaluation is the revaluation which occurred during the year. So I know it is the PPE, the property, plant, and equipment that will be revalued. So you have revaluation surplus. Revaluation surplus. So the opening balance is 9,195, while the closing balance is 11,280. So you have an increase in revaluation during the year. 9,195 minus 11,280. You have an increase in revaluation of 2,085. 2,085. That is revaluation that occurred during the period. 11,280 minus 9,195. 2,085 plus 23,475 minus 3,750 minus 3,840. Then you have 17,900. 970. That is the total. Then the next item is the closing balance in respect of the PPE. Closing balance. So, how much is the closing balance? Let's go through the statement of financial position under the non-current asset. Then you have the property, plant, and equipment of 29,235. That is the closing balance. So we subtract the closing balance. So we have 29,235. 29,235. If you subtract the closing balance, then you have 11,265. This 11,265 is the acquisition of PPE during the period. There is acquisition resulting in an outflows or cash. That is why the closing balance is greater. So you have acquisition of PPE. Then this sum will be reported as investing activities. Acquisition of PPE of 11,265 as an outflows. So by the time the other figures will be written, you may be seeing 13,350 as acquisition of PPE. The reason is because I've done some other workings before I discovered that I've not considered the revaluation surplus, which took place during the period. So this is the correct figure, not 13,350. The correct figure is 11,265, not 13,350. Intangible assets. So the closing balance is greater. That means there is an acquisition. If you go through the note, there is nowhere we read any information about the intangible asset during the period. So since there is no note on that, that means the increase, the amount by which the closing balance exceeds the opening balance represent acquisition during the period. So we have acquisition of intangible assets. The closing is 18,775, and the opening is 16.3. The difference is 18,775 minus 16,300. Difference of 2,475. 2,475. Then after, this is acquisition. Acquisition will equally result in an outflows of cash. Then back to the non-current assets. So we've done with the PPE, we've done with intangible. Then we have trade investment. So we will need the movement in trade investment during the period. Trade investment, the movement in trade investment. That is working number 3. Working 3. Movement in trade investment. So as usual, we normally start with the opening balance. Opening balance under non-current assets, you have the trade investment of 2860. 2860. That is the opening balance. Note 1, you were told a financial asset included in the trade investment with a carrying amount of 1.5 was sold for 1,885 million during the year. So now we have financial assets which was sold. Financial assets. The carrying amount is what will be deducted. That is disposal. Disposal. So since it was disposed, that means it will reduce. So we subtract the carrying amount of 1.5 So if you subtract that 1.5, then the proceed of 1,885 will be reported as investing activities. So the proceeds should be reported as investing activities. That is proceeds from sale of financial asset. Proceeds from sale of financial assets. And that amounted, the proceeds amounted to 1,885. And the proceed is an inflows. The amount received, 1,885, amount received upon disposal of financial asset, so will be treated as an inflow. There are no further adjustments to 860 minus 1,500, then you have 1,360. 1,360. Now, you now compare this sum with the closing balance. Then if you go through the investing activities, you have the closing balance there. Then trade investment under property, plant and equipment. The opening balance of 2,860 have been written. Then we have the closing balance 1,835. So we will adjust the closing balance of 1,835. So we have closing balance, 1,835. If you remove the closing balance, you see the closing balance is greater than 1,360. It's greater by 475 negative. This means there are further acquisition of trade investment during the period. Acquisition of trade investment. So this acquisition during the period of 475 will be reported as investing activities. So we want to recognize that acquisition as investing activities. So acquisition of trade investment, acquisition of trade investment. That is working number 3, and we got 475. Acquisition will result in an outflows of cash. So you subtract that since it results in an outflows of cash. We have interest received, 1,670. There is no interest receivable on the current asset. That is to show that the entire interest have equally been received. So the interest received should be recognized or should be shown as investing activities. So interest received of 1,670. Let's sum up this. 2,520 minus 11,265 minus 2,475 plus 1,885 minus 475 plus 1,670. So you have 8,140 negative. So that is the net cash flows. Net cash flows from investing activity. And that amounted to 8,140 negative. It's an outflows. After investing activity, the next section of the statement of cash flows is financing activities. We have financing activities. I've told you that whenever you get to this section of the statement of cash flows, that you should check 2 things. Number 1 is equity, and the second one is the non-current liabilities, that is borrowings. So your borrowings You should always check the non-current liability section of the statement of cash flows. Now, if you look at the equity section of the statement of cash flows, you have the ordinary share capital of 1 naira each. So, working number 4, movement in equity share. Remember, in all our workings, we normally start with the opening balance. How much are the opening balances? So now let's have opening balances. And our opening balances include the ordinary shares capital of 1 naira each, 11,250. Ordinary share 11,250. Then we also have share premium account 9,300. Share premium 9,300. There are no bonus due during the period. So if you sum up this, how much is the total? 11,250 plus 9,300. That is total 2,550. 2,550. After this, you consider the closing balances. Closing balances. For ordinary share and share premium. Ordinary share and the share premium. Now, how much are the closing balance? Ordinary share 15,000, share premium 10,500. 15,000 and 10,500. So we have 15,000, 10,500. If you subtract the closing balances, then if you look at this, the addition of this is 25,500, which is greater than this. That means there are issue of shares during the period. 20,550 minus 10 minus the sum of this minus 25,500. That is 4,950. 4,950. That is issue of shares. Issue of shares. More shares were issued. That is why you have an increase in share capital during the period. So working number 5, we have number 4 rather, issue of shares. That is from working number 4. Issue of shares amounted to 4,950. 4,950. Let's go through the information we have in the notes. Note 2. You have information about the shares that were issued in the period from note 2. You were told there was an issue of 3,750,000,000 ordinary shares during the year at a premium of 32 kobo per share. So there was an issue of shares at a premium. So meaning that, this is the share issued. The par value of ordinary share is 1 naira. The par value is 1 naira. If the par value is 1 naira and this share is issued at a premium of 32 kobo, so that means it is issued at a premium of 32 kobo. So if you add 32 kobo to 1 naira, so proceeds of share issue, which is 1 naira plus 32 kobo, which is 1 naira 32 kobo. 1 naira 32 kobo. So the share issue is 3,750,000. 3,750,000 times 1 naira 32 kobo. So 3,750,000 times 1.32. So that gives us 3,750 times 1.32. That gives us 4,950,000, which will give you the same result with what was obtained here. So that is the issue of shares. You either use this approach in calculating it, or you calculate it this way. So, or if you want to separate it, you can separate it. 1 times 3,750, you report 3,750 separately. 0.32 times 3,750, that will give you the premium. 0.32 times 750 times 3,750. You record 1,200 as a share premium separate. You record 3,750 as the par value. You record the premium separate in your statement of cash flows. If you do it that way, it is equally acceptable. So that is issue of shares. In note 4, you were told during the financial year, the company paid dividend of 5.4 billion naira to equity holders, and this had been accounted for during the year. So we have dividend paid of 5.4 million. So you can record that dividend paid as financing activities. So dividend paid, dividend paid of 5.4 billion. In case this dividend paid is not given in the question, if it is not given, then you will determine it through the movement in retained earnings. Now, or you have movement in retained earnings. Movement in retained earnings. The starting point is the opening balance. Opening balance. How much is the opening balance of retained earnings? You have 13,860. 13,860. That is the opening balance. Then you go back to the statement of profit or loss. How much is the profit for the year? You have profit for the year of 9,465. And that 9,465 profit will be included. We have profit for the year. Profit for the year. 9,465. And this is obtained from the statement of profit or loss. So if you sum them up, 13,860 plus 9,465, and now it is totaled 23,325. 325. Then you have the closing balance. Closing balance. That is the closing balance of retained earnings. And the closing balance of retained earnings will be obtained from the equity section of the statement of financial position. And that amounted to 17,925. 17,925. So you now include that 17,925. You have 17,925. If you subtract 17,925 from 23,325, so you have 5.4 million. That 5.4 million is the amount of dividend paid in the year. In case, this is given in the note. In case it is not given in additional information, you have to check the movement in retained earnings in order to ascertain if there is any dividend paid in the year. Then after the dividend paid, so we've done with the equity section. Remember, I've told you the financing activity that you should always check two things. Number one is the equity, and the second item is the borrowings. And the borrowings will be found under the non-current liabilities. So you have non-current liabilities, 10% loan notes. The closing balance is greater than the opening balance. I've told you the loans were given in the note 6 that the company is planning to take in long-term loans. I said it doesn't have effect. It doesn't have effect because they are only planning that. So that loan have not been raised or received. It have not been received by the company. So the loan notes yield in the period is the difference between the two balances. Deferred tax has been used in the tax computation. So how much now is now your, issue of loan notes? Let me have issue of loan notes. The opening balance under the non-current liability we have 6.5 and the closing balance is 12,780. You have the difference of 6,280. 6,280. Now, if you sum up everything, 4,950 minus 5.4 plus 6,280. Then you have 5,830. 5,830. That is net cash flows from financing activities. No net cash flows from financing activities. Now, this is an inflows of cash. Now, we want to sum up the operating activities. How much is the net cash flows from operating activities? We have net cash flows from operating activities of 4,832. 4,832 positive. The net cash flows from investing activities is negative 8,140 minus 8,140. Then the net cash flows from financing activities, that is positive 5,830. So you have 2,522. 2,522. That is the net increase in cash or cash equivalent, or you can say net cash change, or increase in cash or cash equivalent. Then after net cash change, you have opening cash balance. Opening balance. Let me say opening balance in respect of cash or cash equivalent. When you add the opening balance, then you get the closing balance. Closing balance in respect of cash or cash equivalent for the period. This is 2024, which is the opening balance. The closing balance is 2025. Amount is in million. So what constitutes the opening balance? You have cash in hand, 360 and 930. Cash in hand. Cash in hand. The opening is 360. The closing is 930. You have short-term investment, 2790 and 3810. Short-term investment. So the closing is 3810. The opening is 2790. Now, remember you were told in note 3 that the short-term investment is highly marketable with 1 to 3 months maturity profile. So because it is highly marketable, that is why we have the short-term investment as a cash or cash equivalent. Then let's go through the current liabilities. The current liability, we have bank overdraft under current liabilities. Bank overdraft. The opening is 7530, the closing is 6540. So that is bank overdraft. So we want to include that. Bank overdraft. So which is the opening 7530. No, overdraft is negative. And the closing is 6540. Then back to the note. Note 8. A cash payment of 58 million made in respect of insurance premium for the financial year ended April 30, 2025 was totally omitted in the books. I've told you, upon the payment of insurance premium, cash goes out. So you credit cash, you debit the insurance expenses. So since it will be credited to cash, that means cash will be reduced by the amount of insurance premium paid. So we want to include that in our cash or cash equivalent. So insurance premium, we are subtracting it from cash. So 58 million, it occurred during a period. That is why you reduce the closing cash balance. The opening balance is not affected. So after this, what is the total? You have 360 plus 2790 minus 7530. This gives us 4380 negative. Then 930 plus 3810 minus 6540 minus 58. So this gives us minus 1858. So the opening is negative 4380, 4380 negative. The closing is 1858 negative. Now let's confirm if it agrees. 2522 minus 4380, that gives us 1858. So it agrees. This marked the end of the solution to the question. Please drop the love emoji, like the video, also share it with others. Thanks for watching ZICA.